Alrighty, good evening, everybody. Got a good turnout tonight. All right, I'm a little late, so let's get right into it. If one of you could just let me know my microphone's working, that would be awesome. Sweet. Alrighty, looks like everything is good. Just getting things ready here. All right, guys. Welcome to the Hurley Investments Market View commentary of November 28th. You're at the end of November here and getting into the Christmas season. Obviously Kevin is off for the night. He's off in Houston visiting his parents and wasn't able to make it work for tonight. So I'm with you tonight. Hopefully that's all right. Lots to talk about. A couple weeks ago, I was on here with some of you guys, and I still have a couple of my notes that I just wanted to reiterate and go over. Not everything, but just kind of some things we talked about that I feel are helpful for all of you. And so if you missed last time, just wanted to hit some points again. Talked about what we were doing, and it's not changed a whole lot. The tough part of this year just is sitting on our hands and being patient while markets go up. When the market was down 25% and some of our stocks were down 70%, allowing our puts to do their work. The way we've done that, some points here, wading through a lot of the news coming out. There's been lots of negative news and some positive that has pushed things up and moved things down. Some good news doesn't necessarily outweigh the ongoing bad news. We've had a couple weeks ago where, and that refers to inflation numbers, the inflation rate coming in lower than expected, even though it was still a higher month over month number. So that's what that's referring to. On all of these up runs, you can see in our market here through the summer, allowing our stocks to make their runs, getting protection on through the downturns. And of course, all these little blips on 4-day blips that go up and these 1-day blips that go up. And you can see way back earlier in June when the market was still trying to figure out if it wanted to go up. All that has been tricky, of course, but as we've watched the longer trend and taken a step back, that has made all of the difference. So the way we do that, of course, is going back to the basics, keeping an eye on our technicals, finding our support and resistance levels, keeping in mind our fundamentals, which, updates every quarter with our earnings reports, and we go through those earning reports, we understand them, we weigh that always against any of the perception and news that's out there. We know that Apple still holds tons and tons of cash, still has ridiculous amounts of cash on hand, still has ridiculously good margins, and is moving factories over to different countries to diversify out of the risk that China has created for their production. Things like that help us understand whether or not we can ignore, what kind of news we might be able to ignore or weigh more heavily. And then, of course, market sentiment. You can feel these moments when the market tries to fight up and buy in the dip and move up, and you saw that again from last summer after we had the one negative month over month inflation number, and everything went up to right this technical resistance level again, going back to the technicals. And so we use market sentiment that just requires experience. You've heard probably about in some of the trading classes, you know, there's numbers that evaluate market sentiment. You look at your option spread, and if there's more calls being bought than puts being bought and all that stuff, that's all nice and helpful, but this is the one that just takes experience. The experience to know what kind of news matters and what doesn't, what kind of news is causing an overreaction and what doesn't, and what kind of news is being ignored. So it goes hand in hand with these economic reports and the news, because all of that affects the perception of investors in the market. And of course, their perception affects market sentiment. And then we'll go over this in a second. So what have we been up to over Thanksgiving, which needs a capital? And you can see market has just gone up and down, a little bit sideways to up these last 2 weeks. We had gotten some protection on as things started to fall down. We added some SPY puts protection on this day, on the 17th. And of course, the market starts to rally again. And this morning, as we talked about it, and these days we talked about, okay, well, do we take that extra SPY protection off, or do we let it run? And what Kevin and I just kept coming back to is the fact that it's struggling to take off above and touch the 50-day, excuse me, the 200-day. It's the market sentiment is still negative. And on a day like today, we hit a technical, I'll pull up the SPY. You can see it a little better. It's supposed to follow the S&P, but check this out. There's quite a difference between the SPY and the SPX, where it didn't quite reach that 200-day moving average that it met on the SPY, hitting a technical point and coming down on a day where we have news of Black Friday numbers that were record numbers. Consumer debt has gone up, which is not a good thing. And we just kind of weighed some of these things together. Instead of pulling off our SPY puts, instead of pulling off protection, we were patient through this last week and this short little run up in our markets. And we looked to find higher the highs to be adding protection. So this morning we added more SPY puts at a higher strike to make more on the way down. So we had 390s down here. We added, came up, touched this technical resistance, came down today. We added 395s today, just to kind of dollar cost average that position and see if we can't do a little better on the way down, as it looks like it's struggling to get above that 200-day. Just taking a look at our pre-markets. I don't know if those have updated yet, but they look awful. Extended hours on our stocks, things are slightly positive, which is what you might expect after a down day, but nothing looking great to take off, and doesn't necessarily mean anything right now. So as a way of giving you a bit of an update on what we've been doing, some things we've been rolling up, we've been adding more protection on various stocks that hadn't been protection, that had protection, or stocks like Disney where they were making a run and we pulled protection off to make a little something on the way up before hitting a technical resistance level and coming back down today, where we're getting protection back on up at 98 earlier this morning. So that one is looking good, but just trying to feel our way around the market. Hey, we should have good news in black numbers, and yet the market is going the wrong way. That's not a positive sign. Are we even going to get a Christmas rally? I don't know. We also talked about last week the question that I keep getting, especially when we're in a bear market like we are, right? Why can't stocks just go up? And it's usually a question that I get with people who just find out what I do and find out that I manage money in the stock market, and they ask this question, and it's a question that I think is asked because people assume that because everybody wants the market to go up, that, you know, why can't it just keep continuing to go up? Everyone wants it to go up, why can't it continue to do that? And some of the points I made are, not everyone is betting on the market going up. People bet against it. They short the stocks, they short the market. Not everybody wants it to go up. There are inverse index funds. There's all sorts of stuff. Macro events. People don't want to lose money. No one likes to lose money when they hear about bad news. Company is having a struggle on their earnings. A sector is having a struggle. People take their money out. They don't want to lose money. you can't just hope that the market is going to continue up forever, because it did a nice bull run over the last 10, 11, more than that, since 2000, bottom of 2008, 9, right? You can't just assume that it's always going to do that, because the 20 years before that, well, the 20 years before 2013, where the market came back to its highs on 2007, from 2007, the market basically went sideways. And so people forget that it doesn't always just go up. And so it's a surprise when we have struggles in our economy, struggles in the market, and they want to see their 401ks end up where they're moving, where they want to see their 401ks move up the way that their investment advisor showed them it would on a nice, pretty linear graph. But if you've heard me or Kevin talk about those financial plans that show those linear graphs, you know that it's complete bullcrap. The market is not linear. I mean, look at this. $4,300 high, 3,600 high. It's 800 points. It's ridiculous. 900, I guess. The market is not linear. So the moral of the story, don't be naive. The market is not your friend. You can't just passively index the market and hope that it will all continue up for the foreseeable future. You have to find a solution to protect your retirement funds that you need to live on in spite of market downturns, and you can't just expect that you're always going to pick the stocks that are going up. And you can't just hope it will come back later in the time frame that you need it to. Because again, 20 years, it went sideways. All the while, investment advisors were charging their clients and telling them, don't worry, you just gotta be patient, it'll come back. It destroyed retirement. It destroyed 401ks. The biggest, most important tool that you have is dollar cost averaging. Buying low, selling high. Buying stocks at cheaper prices to lower your cost basis, lower your break even. And we dollar cost average in our management style by protecting to the downside. We're using put options just like insurance on our stock portfolio, so that we can buy thousands of more shares across several accounts of Bank of America. So we can buy, when the time is right, more shares of Disney. So that it doesn't have to be up at $200 a share when we've broken even on Disney. We can cut it down 30, 60%. Our break even is lowered every time we dollar cost average. So that's the moral of the story. The other moral of the story is this. We have to keep in mind as we weigh decisions on protecting our stocks that we are in a recession. We've been in a recession pretty much for the whole year. 2 consecutive negative GDP quarters. Maybe I could spell quarters right. Any morsel of a positive news like we had a couple weeks ago that our inflation didn't come in quite as high as we thought it would, has to be weighed with all of this. Last week we had the good news that from the Fed minutes that they think we might be close to where they would slow down their rate increases, their rate hikes. That helped into the end of last week. And here we are once again hitting a technical resistance level and coming down. And of course, we'll probably have some days this week where it tries to fight back up. But I can tell you, I'm glad that we have the protection on that we have on. Because we have a rate hike coming up, and depending on whether it gives us, they give us a, depending on what they say for their guidance on the future, speaking of the Fed, but that will make or break really whether we have a Christmas rally. So I'll say Feds are looking to raise rates again. But the market will react based on what they comment on for the future rate hikes. And if we get a 50 basis point hike instead of a 75 basis point hike, which is what is kind of expected. We'll enjoy a nice Christmas rally. So that'll be mid-month. Right now, not terribly optimistic that we'll get that. Not terribly optimistic we'll get a Christmas rally next year. What else do we have? Big companies laying thousands of employees off. Best ever Black Friday numbers. Oh, I need to capitalize everything. But usually that's a positive thing. Problem is, that's partly because everything is more expensive. And people are buying Christmas they're buying Christmas gifts on the pay later. Trying to remember the company that does that, but you know, you can buy it with whatever it is with 4 payments with no interest, right? So a lot of that is happening for lower priced stuff, whereas before last year and 2020, a lot of big purchases people were making were on those pay over time sort of things for, you know, there were bigger purchases whereas now it's for a lot of smaller insignificant things. So in my opinion, people are getting over leveraged. Spending money they don't have. So those are some things we're looking at, some things that we're keeping in mind to weigh against any positives. But like I said, if we get a 50 basis point hike, that's going to signal to the market that the Fed is starting to slow down their rate hikes. And could offer a really nice Christmas rally. What are your thoughts or questions so far? All right. Stuart asked, reaction to news in China. Are you asking me my reaction, Stuart? So it kind of worried us with regard to Baidu, of course, as it's the Chinese Google, because it was up really nice. It was up like 3% today. It was up $3 and then kind of settled back down to only being up 1%. But in spite of what's been happening in China, Baidu has made a fantastic amount of money, had a great earnings report a couple weeks ago. Actually, it was what, the 17th? Can't seem to get above that 50-day, so we've kept protection on. Other than that, the worry is how it affects Apple, and I think that's probably what has been worrying the market, and you see that kind of drop back down below the 50-day for Apple as they have some of their plants there. But like I mentioned earlier in passing, Apple's been moving a lot of their production for their iPhone, other things, off to India and Vietnam, I think, Taiwan. So they're recognizing the issues that are coming out of China and their zero COVID policy that is just killing them, and also the political climate that with regard to the U.S. there. They've taken that into consideration, moved things around, and have been really smart. So I don't know that I have a comment on China specifically, other than with the stocks that we have seem to be faring quite well and doing the things they have to do with regard to Apple and Baidu to weather any production storm that's been happening in China. But it's been happening for a while now, so it's kind of like, if you haven't started to figure something else out, then rely so heavily on China, then you're way behind the 8 ball. So, Jeff asked, what price would tell you to take off puts on the S&P? Let me go back here. SPY. So I might be looking, since we have 2 sets of puts now on the SPY, I might be looking to take the higher ones off and just keep the 390s. So we have 395s and 390s. If we get to 390, the question is, okay, we can either keep both of them on, we can take the 390 set off and kind of get our break even back and keep the higher strike ones on that are further in the money. Or we can hold the lower strike ones at 390 and sell off our 395s for a profit. My thought though would be to just hold them on for the day they get back to 390 and see whether it continues down, because it can obviously get down to 378 at that technical support level down there at the 50-day. But so it would either be that or just take off the 390s for a break even is what my preference would be, and to just keep on the 395s where we could, if it continues down, we would still do better. If it didn't, and comes kind of bounces on the 390, we could still take the 395s off for a profit. That would be my line of thinking. I will say, Stuart, it is nice to see the Chinese people start to get a little fed up with the Chinese Communist Party and start to show their displeasure with being locked up for 2 years, 3 years really, because it is ridiculous. I hope and wish them the very best, because their government is just not helping them. All right. Already hit some of these earnings dates. A lot of good ones. Costco did not do so well. But for our stocks, we are past those. And we've talked about those. I've got our big picture from briefing.com. Just want to, you can read through this later, but I just want to emphasize kind of the end here that I like to look at. Let's see. Talks about Walmart, how they did so well because people are for their earnings, because people are moving a lot of their buying into Walmart, which has cheaper stuff, instead of something like Target. That kind of summed everything up. Target did awful, Walmart did great. So that migration is destined to persist as the Fed keeps raising rates, as more companies announce layoffs, as the housing market continues to cool, as debtors face higher repayment burdens on variable rate debt, and as consumers continue to draw down excess savings. As an aside, the personal savings rate as a percentage of disposable personal income is 3.1% versus 33.8% at its pandemic peak. That is quite a difference, 33 versus 3. Other than the 3% rate seen in June, that is the lowest it has been since the financial crisis. Everybody's money that the government checks, the stocks and crypto cash they cashed out in 2020 and made all that money is getting dried up. It goes on that that's not a good starting point, with the Fed desiring some weakening in the labor market to tame wage-based inflation pressures. It leaves many consumers in a precarious position should they lose their job. On that note, CNBC highlighted a Lending Club report that indicated 60% of Americans were living paycheck to paycheck as of October, up from 56% a year ago. This understanding could ultimately work more in Walmart's favor, but what's good in coming months for Walmart, the world's largest retailer and US largest grocer, won't necessarily be associated with an economy that is in good shape. Right now, the shape of the yield curve and the low level of personal savings suggests Walmart should have more business coming its way. Basically, when Walmart does better, does not look good for the economy necessarily. What are they talking about with the yield curve? This is the yield curve. They compare the 3-month to the 10-year. They compare the 2-year bonds to the 10-year bonds. And when those go negative, typically a very bearish indicator, at least in terms of forward-looking what the economy will do. Employment has been the one thing that has made everyone say, well, we're not really in a recession because we have such good employment. And again, that is looking like it's starting to turn. I will say though that is the reason, part of the reason the Fed keeps raising rates is to cool down the employment. So if that comes down and keeps coming down, that's going to be the reason the Fed goes for lower interest rate hikes, slowing down their interest rate hikes, and possibly stopping rate hikes altogether at some point next year, a little earlier than maybe expected, which is going to turn our market positive. It's kind of like bad news is good news. And it is always the weirdest thing. But that's how it goes. Any other thoughts or questions on that? My thought is that we're going to end our markets negative for the week. This is an old chart of the Dow. Let me get the new one. Actually, let me get the, I like to do the SPX, but S&P first. Got the Dow. And the NASDAQ. Almost got it. Thanks for bearing with me. We'll have a moment of silence in hopes that our market will continue up, will go up. Everything will be all right. Okay. Dow, I'm going to say bearish. You can kind of see our chart here hitting that same high it did a couple months ago in August. I would think we're at least going to have some trouble getting over those numbers. So I will say bearish. S&P bearish. I'm going to say bearish for the NASDAQ just because the other two are that way. But because it's all filled with all the tech stocks, it could be just that it goes sideways or tries to hold on to that 50-day as people feel that the tech stocks have been beaten up enough. But really kind of a losing battle when the other two indexes are not headed in a good direction. All right, where will the S&P end in November? I'm going to say 0%. You go back to the S&P, this was our 36, let's see, opening day, where was it? First day of the month, opened at 38.56. High up at 4,000. Currently at 39. We're really not that far away from being at 38. But a couple more days, we probably could be at 39, which is pretty much flat. Maybe you could say up slightly, but that's what I'm going with for now. Earnings are pretty much over except for a couple more retails, which we'll keep our eye on. We have HP, Hewlett Packard, Wolf is PetSmart, I think. CRM, just another tech stock. Big Lots. What was DG? I forget. Dollar General, KR, Kroger, Ulta, some more retails just to keep track of and see how they compare with what's happening with Walmart. Wednesday, employment. It's not a real GDP number. It's more like, let me see. Second estimate. But we have the ADP unemployment or employment that will be something that may move the market, and then non-farm payrolls, unemployment on Friday. So that's what's happening this week, and that's what we're keeping our eyes on. How am I looking to trade? I basically just said as much. I'll say enjoying. Oops. Oh my goodness. Enjoying having protection on. One more thing I do want to say. If we're worried about a true recession, a more deep recession, more problems for next year, the place to be is what? recession-proof stocks? I'll give you the answer since we're running out of time here. Do we have recession-proof stocks? Well, what are recession-proof stocks? They're stocks that command pricing. They have cash on hand, history of weathering past storms, Disney, plenty of cash. Yeah, they were kind of kicked in the butt while they had to shut things down for their parks, but they weathered it. 60% profit on movies, which other companies get 30%. They can command pricing power. Apple, loads of cash. Great margin. They can command pricing. They can weather the storm. Ford, great car sales. Yes, it's kind of petering out right now, but look how they did in the financial crisis. Remarkably well compared to the other car manufacturers. Bank of America, JP Morgan, making more money with higher interest rates. Those are some few of them. I guess the point I'm making is not only are these stocks what you might want to have through a recession, they're also growth stocks. They're also value stocks. And by the way, this, I'll say, doesn't mean that their stock prices won't look awful. It means they will weather, oh my goodness, weather the storm well and put us in a good position into the future. And of course, being able to protect stocks, add more shares, dollar cost average, it all puts us in a good position. Even though there's possible big recession looming, as opposed to the maybe small one that we're in, we can put ourselves in a great position to jump back quicker because we've lowered our cost basis, add shares. It's all about accumulating more shares. And that's all I had for you tonight. Is there any other thoughts or questions, things you wanted me to go over? That was a good hour of throwing tons of information at you, thoughts and what we're looking at and what we're trying to do. Let's see. Jim asked, with Europe moving back to a more sane approach regarding energy, will it push up energy values? I'm not sure what you're referring to because they have put themselves in a position where they're too reliant on cheap Russian energy. But if they're not going to go full bore on climate change nonsense, then I would think that means they're going to try to use more traditional energy routes instead of all of the less reliable, more expensive renewable energy sources. But I don't see how they do that without Russia because of the place they put themselves. Jim says they're going to coal and other hydrocarbons. So yeah, exactly what I said. They don't really have a choice. So that would move energy prices down. So they're going to produce more of those. It will allow them to have cheaper energy, which is what they need, and not to be so reliant on Russia. And the only reason I say climate change nonsense isn't because the climate isn't changing. It's nonsense because renewable energy sources are too expensive and will do too little to help the change in the climate, with China continuing to pump out plenty of carbons. That yeah, I'm not sure where my train of thought went, but yeah, it will do far too little to help. And the fact of the matter is, if you can't produce energy cheaply, you're just gonna hurt a lot of poor people. So it's unrealistic. So that is good news to hear, Jim. I haven't been following that as much. Is there any other thoughts or questions? I will get some articles posted here as well. I didn't get the time to go over those, but I'll get some things posted. Doesn't look like we're having any more questions coming through. Thanks, guys. Was a nice one tonight. Appreciate the comments, the questions, and I should be back with our Thursday trade findings webinar. If you want to join me then, we can go over some more stuff. see how things pan out through this week and see where things are out on Thursday. So, all right. Thanks, guys. Thanks, Jim. No problem. That'll do it for me tonight. Have a good one. Talk to you guys Thursday.